You are watching the screen as price action suddenly accelerates. It smashes through a historic high, and the chart flashes green, climbing higher into what looks like a massive breakout. Discipline often erodes here. The fear of missing a major move takes over, and the urge to jump in before it's too late overrides the trading plan. You click buy, entering right at the peak of the momentum. The moment your order fills, the move stalls. The price reverses instantly and collapses, sweeping through your stop loss and wiping out the position before you can even react. These reversals happen at historic highs because that is where breakout orders are most concentrated. Large-scale participants utilize that sudden surge of buy-side liquidity to fill the massive sell orders required for the move in the opposite direction. In this environment, trading the standard breakout puts you in a vulnerable position. You aren't participating in a trend. You are providing the volume necessary for institutional traders to exit their own positions. How does a trader navigate a market where the most obvious signals are often designed to fail? Survival requires shifting your focus away from the breakout itself. To find consistency, you must learn to identify the footprint of manipulation and align your trades with the reversal. The framework for identifying these traps is known as candle range theory, or CRT. Mastering CRT allows you to move away from providing the market's liquidity. Instead, you learn to read the specific candlestick structures that signal where capital is actually being moved. We begin by zooming out. To establish the macro context, we use a higher time frame, like the 1-day or 4-hour chart, to look past the intraday noise. We look for levels like this old high purged, or OHP. These peaks are significant because they represent areas where retail stop losses are typically clustered, making them primary targets for price manipulation. In candle range theory, focus on a thick-bodied candle purging these old levels. The density of this candle body is visual evidence of engaged liquidity. Pushing past a previous high confirms large-scale capital has entered the market, proving a shift in momentum is likely. This thick CRT candle maps out the range for our analysis. It identifies the price zone where the higher time frame reversal originated, serving as the key level for the rest of the trade. Once the higher time frame context is set, we drop down to a lower time frame, such as the 5-minute or 1-minute chart. This is where we pinpoint the exact entry signal inside the macro trap. The micro-level trigger we look for is turtle body soup, or TBS. This pattern identifies the fake breakout as it happens on the faster time frame. A valid TBS has a very specific rule. It must be the first candle that manipulates the old high or low and closes its body past that level, signaling that the initial breakout is failing. Even with a valid TBS, entering a trade requires patience. Entering blindly on a single candle increases risk. We need confirmation that the reversal is holding. This is Model 1 confirmation. We wait for a thick order block candle to form immediately after the TBS. This second candle provides the necessary evidence that the market is ready to move in our direction. While the order block is a primary trigger, other models exist. You can also look for a fair value gap in Model 2, or a clear break of structure in Model 3, depending on how the price action develops. Layering this micro-level confirmation over the macro context creates the signal to execute the trade. Execution is mechanical. The entry is placed at the close of the confirmation candle, with the stop loss positioned behind the high of the manipulation move. Taking profit follows a strict rule. The primary target, TP1, is the 50% mark of the higher timeframe CRT candle. This midpoint is the high probability zone for reversals. By targeting it, you extract profit before the market encounters resistance that could stall the move. Successful trading is about executing a mechanical exit. You secure your gains at the calculated target before the market has the opportunity to shift its direction again. There is a sharp contrast between the emotional reaction to a breakout and the systematic execution of this routine. While the amateur reacts to the price surge, the professional waits for the time frame alignment. The market functions as a mechanism that transfers capital from those who act on impulse to those who can wait for the confirmation of manipulation. By utilizing candle range theory and turtle body soup, you move past reacting to market traps. Instead, you learn to identify them as they form and capitalize on the liquidity they provide.